Hey everyone, it's Nate, and today I'm going to show you how you can pay off your house 15 years early. Get it? Welcome back. My name is Nate, and I'm here to help you master your money. So there is so much information and input out there on so many different ways to best approach finances as a whole for your life and how to plan for everything. There is so much information that you can find on investing, dealing with debt, buying a house, building your credit, how not to blow all your money on jet skis and Lambos and all that. Some people don't quite get the message, but the information's out there and exists. But there is a vital part of the personal finance holistic solution that is missing from most people's approaches. Life insurance is a critical part of any successful financial game plan. Life insurance allows you to leverage the income that you have now to provide a financial shield for your family for when you're not able to provide. For most families, a primary life event that triggers someone to even think about life insurance is going to be getting married, having a child, or buying a house. Today, we're going to be discussing the latter. Life insurance is intended to, at minimum, cover all of the debts of an individual so that if something happens to them, their family is not left having to foot the bill. And considering that buying a house is typically the largest debt any one person will take on, this is why most people get life insurance set up shortly after buying a new house. So there are many different approaches one can take when selecting coverage, but in most cases, the solution involves getting a term life insurance policy with coverage that is at least the balance of the mortgage, but usually slightly higher. The term of a term life policy is usually set up to match the length of the mortgage. So for example, if you get a 30-year mortgage, you would likewise get a 30-year term policy. And just for those of you who don't know, a term life insurance policy is one that is meant to be in place for 10, 15, 20, 30 years, and at the end of that time period that's preset, the policy would expire. These are typically more cost-effective policies than permanent options and can offer a lot of great benefits that whole life or universal life may not. And so for this short example, at the end of the 30 years, the house will be fully paid off and the policy would have expired. So just so you can see what this actually would look like, let's add some real numbers to this. Let's say for this illustration that the house that was purchased had a $200,000 30-year mortgage. And so the term life policy that would go along with this to match it would be for $200,000 of coverage with 30-year term. With a good credit score, one can get a mortgage rate of about 7%, and assuming the person lived in Dallas, Texas, their payment on the 30-year mortgage would be $1,884 each month. And also assuming the individual that bought the house was a 45-year-old male that's relatively healthy and not a smoker, $200,000 of coverage for 30-year term would be $155.23 each month. And over the course of 30 years, the total for all of this combined, for all the monthly payments, would come out to $534,900.60. So this is an option most people go with, and if you're on a tighter budget, this can make a lot more sense and offer more stability long term. But let's say for this example, this individual does have some flexibility in their budget, but they also want to pay their house off early, but they also want to ensure that if something happens to them, that their family isn't left paying a house bill. Is there a way to satisfy both these things at the same time? And the answer to that is yes, there is. So there are some term policies out there that are called return of premium policies. These are almost always going to be attached to a term life policy, but not every single term life policy out there is going to have this return of premium option. And let me explain what return of premium actually is. So on a regular term life policy, you pay in money over the term of the policy, and at the end of the term, the policy expires. The money that you paid in, that goes to the insurance company to cover your coverage for the time, and you don't get anything back. With a return of premium policy, it's going to have a slightly higher monthly payment on it, but at the end of the term of 15, 20, 30 years, you will get in every penny that you paid into it at the expiration date. So effectively, you get to have all the benefit of having this coverage in place, which in many cases is not just straight life insurance, but also disability coverage. So if you become disabled or have a heart attack, stroke, cancer, stuff like that come up, you can claim up to the full amount of the policy early while you're still around. That exists in a lot of these policies as a built-in benefit, but you get all your money back at the end of the policy. So if structured properly, these policies can cover paying off the balance of the mortgage that you have if something were to happen. But if nothing happens and you make it through that term just fine at the end of it, as long as you paid all your premium into it, you'll get every single penny that you paid back. And in some cases, if this is done right, it can be structured so that you can pay off your house potentially 5, 10, or even 15 years early while protecting them in the full balance of the mortgage the whole way through. And generally when people get policies like this, they won't just get the amount of the mortgage. They'll also build into the policy a few years of income replacement if something were to happen to them. So for this illustration, let's use this guy named Jeff. Say hi to Jeff.
My name is Jeff.
And Jeff is living in Dallas, Texas, and he earns $90,000 per year before tax. Jeff just bought a house and now has a 30-year mortgage for $200,000. He wants to make sure that they would have income provided for them for at least 2 years of his take-home pay and also protecting the balance of the mortgage. So in total, the amount of coverage that he would be opting to get on the return of premium policy will be about $325,000 of coverage. Now, like in the previous example, Jeff is 45 years old and relatively healthy and not a smoker. And he has very good credit, so his monthly mortgage payment is $1,884, and the monthly premium on the insurance is going to be $833.54. Altogether giving him a monthly payment on the two of $2,717.54 each month. Now, this premium amount is assuming a 15-year return of premium policy with $325,000 of coverage. So what this means is the policy is going to expire at year 15. And if we look here on an amortization table with the information provided previously on a $200,000 mortgage for 30 years with a 7% interest rate, you can see that the total payoff amount for the entire house is going to be $479,017.80. That's the original payoff amount and how much Jeff would pay over the course of 30 years, not factoring in an insurance policy, just for the house. This is how much he would pay total in all of his payments. And so if you take a look at the amortization table here, you'll see that at the end of year 15, he's going to have a balance remaining on the mortgage of $148,037.73. And if we do some quick math, we can see the amount of the return of premium for the end of year 15. The cashback amount would be $150,037.20 back. Now that is just slightly over what his mortgage balance would be at that point in time. So if he were to get this policy set up, he would be able to pay off his house 15 years early, and the amount of interest saved from doing so is going to be $91,471.17.
Hold up. Wait a minute.
What? That is a massive amount of money to save on something like this. Even just putting a little bit extra towards your mortgage every month can be a massive way to help pay it off quicker. But doing something like this is leveraging insurance and an early payoff schedule. So you're getting to do both at the same time. So for this illustration, let's say that Jeff at year 12, let's say he has a serious issue, ends up having a stroke. Well, by the terms of this kind of a policy, he would have the ability, if he wanted to take out the full 100% of the policy early if he needed. So that means he and his family would have access to $325,000 that they could then take to pay down the mortgage, or they could take to use as income replacement or whatever was needed. But if nothing happens, if he's totally healthy, makes it all the way through, makes no claims in the policy, at the end of the 15 years, his house will be totally paid for, free and clear. So I hope this example was beneficial to you guys. I just really wanted to show you there's so many different financial tools out there you can leverage to help your family out and to really solidify your financial game plan. I personally have half a dozen policies on myself, so my wife better not get any ideas about like pushing me off a cruise ship or something, because that would be a little problematic. We have it filmed here, documented, so honey, don't get any ideas. I'm not sure where you're at, but anyways, this has been an educational thing to try to show you what's possible, what can be done. But the critical thing here is that it's done correctly. Anyone can set something up and say it's going to do something, but for your own education and to make sure your families know exactly what's going on, anything involving insurance, please get every single thing in writing. There are some less than honorable people out there that will literally just say anything just to get you to sign up for something, and you think you got the world, but really it was something that was pretty crummy and going to expire in like 5 years, or the price is going to get jacked up in a few years and they didn't tell you that. So always consult someone who's professional, who you trust. for this stuff like this, it is one of the most critical parts of the financial game plan. And I'll share a bit of a personal story just while I have this going here. I wasn't planning on this. I didn't have this scripted, but this is something that's very critical and important to me and for my family. So for those of you who know me personally, know me for a while, you might know this story, but my father passed away a little over 4 years ago now. And when he did, he had been sick for a while, and when he passed, he was the sole breadwinner for the family. There was young kids in the house. My mom's disabled, and no life insurance, nothing in place to help. So when that time came, the bank took the house. We had to go live with grandma, and it caused a lot of upheaval in the family. And I had to essentially go begging, more or less, to lay him to rest, just to take care of covering funeral costs. And this is what I lived through. This is what I dealt with, and it was going to suck either way. No matter what, you're losing a critical member of the family, someone you love very dearly. It's going to suck. But what made it so much harder and more complicated, and instead of being a time to grieve and to process feelings and to be with family, the time afterwards, he was fighting for survival and fighting to breathe, and nothing was going right, and resorting to doing things that was really not what you wanted to see for your family. And so, having lived through that, having been through that, I personally take a good bit of my income, and it goes towards this. It makes sense for me. This is something I personally really believe in, and I help people out trying to avoid these kind of situations that I went through. I lived through it. I don't want anyone else to have to deal with that if that's possible. So part of my passion for this, and why I even got my license to do this, was because of the situation with my family and how sucky it was. So if this is going to help anybody with anything, if this is going to benefit one person, maybe from preventing their families from going through what I went through, that's a win for me. So let this be a bit of information, education for you. Any questions, drop a comment below, shoot me an email, whatever. I'm here for you guys. But thank you for chiming in. I hope to hear from you guys soon. I'll see you in the next one. Oh, if you haven't, please hit the can't talk today. Please hit the subscribe button if you haven't already. Hit the like button, and I'll see you guys in the next one. Bye.